family real estate guide. Nagaraj Chennaya, the one-stop shop for all real estate needs. Call 408-805-4653 or log on to nagarajhomes.com.
Welcome to the Real Estate Show, where your journey to a smarter decision begins. I'm your host, Nagraj Anaya, your trusted Bay Area realtor, joined by expert elder from CPA Dude. We explore the dynamic world of real estate, tax strategies, and financial planning, giving you the tools to build wealth, save smart, and thrive in today's ever changing market. Whether you're a first time buyer, seasoned investor, or simply looking to make better financial choices, you have come to the right place. Let's dive in because your future deserves the best foundation. Hello, Elder. Welcome to the show.
Thank you, Nagaraj. I'm happy to be here.
Yeah, listeners, if you have any questions on the taxes, it's all about the tax season right now. It's like if you have any questions or anything on the real estate, you can give us a call. Our studio line numbers are we are live. Our studio line numbers are 877 Bali 92 or 877 265 5992 877 265 5992. So, Elder, since this year is ending up, let me start with the question. What are the last things for taxes to take care for business owners and W 2 income? Let's talk about both of them.
Definitely, yeah. So on the business side, you definitely want to get all of your year-end expenses in order. So for example, let's say you have a really good year and you have a lot of income. Definitely think about prepaying your Q1 and Q2 expenses for 2025
Mhm.
at the end of 2004. That way you can take the deduction this year instead of waiting for next year. And then on the W-2 side, it is super important to max out your 401k accounts. So we still have about 2 weeks. Make sure you max out those 401k accounts. Your limits are 23,000 or 30,000 if you're over 50. So make sure you get those in.
Okay. So for W 2 income, make sure you are getting all your 401k maxed out. And the business owners, right, Elder, like one thing you told us, like write a W 2s for yourself. Like, can you repeat, come again on the business owner's perspective?
Definitely, yeah. So as a business owner, if you wanna create some expenses for yourself for
Correct.
2024,
Yeah.
prepay your expected expenses for Q1 and Q2 of 2025 at the end of 2024. So for example, if you pay a vendor monthly, think
Yeah.
about paying them for the entire year in December.
Yeah. Listeners, like if you're a business owner under W 2 income, watch out for what Elder has said. It's very important to plan your taxes very properly before this year ends. So if you have any questions on your taxes or if you have any questions on the real estate, this is a time you need to call us. Our studio line numbers are 877 265 5992. How about Elder, like how about write off your cars and how to defer it?
Definitely, yeah. So if you're a business owner or if you're a real estate investor, writing off your car is a very popular method to get a pretty big deduction. There's two ways to do it. You can take mileage deduction, super easy. You can take 67 cents per mile for every business mile you drive, which adds up pretty quick. Or if you use a car more than 50% of the time for business, you can depreciate it. And if your car is more than 6,000 pounds, if you're driving, a big truck, a big SUV, then you can expense the entire car in year one. So, we have clients that are business owners that buy, expensive G-Wagons in December, finance them, and write them all off of their income for 2024.
You can write off completely the new car.
If it's above 6,000 pounds and you have enough business income, you definitely can.
Listeners, why wait? Like, if you have any questions on your real estate or any on the taxes, you can give us a call. Our studio line numbers are 877 265 5992. So that's a good to know. Like, you can write off completely a new car, but it should be more than a 6,000 pounds. Only few cars qualify for it, right?
That's right. It's mainly large SUVs, some vans as well as trucks.
Uh-huh.
But let's say you still want to get something fancy and you want to write the whole thing off. Well, just lease the car. If you lease the car and it's 100% business use, you can write off the entire lease.
Oh, you can, how about it's only one car, or like if you have a multiple cars also you can write off?
You have multiple cars, you can definitely write off multiple cars,
Mhm.
but you still need to have some personal use. So if you only have one vehicle, you can't claim it all as business use. You might be able to get 80-90% of the way there, but
Mhm.
it's highly unlikely, you'll use one vehicle exclusively for business use if you only have one vehicle.
Okay. Now, one more important thing is let's talk about the depreciation for the real estate. Let's say we have an individual, there are individuals like basically have a investment properties. Okay, and they were primary residents too. Let's talk about how to depreciate the properties around and what is that real estate rep means and how do they qualify for short-term rental. Let's talk one by one. The depreciation part. How do you do the depreciation for any investment properties?
Definitely, yeah. So there's something called standard depreciation. It's 27.5 years for residential property,
Huh?
39.5 years for commercial property. And then you can also trigger bonus depreciation with a cost segregation study. So this study allows you to take additional depreciation in year one. It's a very, very wide range, but you will get to take bonus depreciation of about 15 to 25% of the property's structural value in year one versus spreading it out over the lifetime.
Okay, it's a 15 to 20% for the first year. Listeners, if you have any questions on anything on the taxes, because that all about the year end is coming up. If you have missed out on your taxes, if you have any questions, you can give us a call. Our studio line numbers are 877-265-5992. Myself, Realtor Nagraj Anaya, and I'm today joining with Elder from CPA Dude, who does the year-long tax planning for you. If you have any questions, do give us a call. Our studio line numbers are 877-265-5992. That's one of the depreciation. But let's talk about the short-term rentals, like how it is like. Let's take up one call. We are getting it. Hi, welcome to the real estate show. Your name, please.
Hi, my name is Venu.
Yeah, hi, Venu.
How are you?
I'm doing good. How are you doing, Venu? Thanks for calling.
What, baby?
Yeah, please.
I'm doing good as well.
Yeah, please go ahead with your question, Venu.
Okay. Yeah. So I have a question on real estate only. Let's say that we are on a H1 and we have an investment property. Can we do the depreciation on our W2 or we are not allowed to do on W2?
It's a great question, Venu. I think I'll allow Elder to answer, then I'll have a follow-up answer for that. Elder, please go ahead.
Definitely, yeah. So to answer your question, to take bonus depreciation, very important that you qualify two things. Number one, your short-term rental needs to have an average stay of 7 days or less. So you got to add up all the days divided by the number of stays. That number needs to be 7 or less. And you have to show 100 hours of work. So you need to maintain a log of work that you did on the property, buying it, getting it ready for Airbnb, renovating it, staging it, managing it, that kind of things. As long as you have those two things, you should be able to deduct it from your W-2 income. It's somewhat of a gray area. This is more of like an immigration attorney question, but from our perspective, we really don't see why you can't do that as an H-1B.
Okay. So, Venu, like both of husband and wife are on the H1B or a wife is in the H4 EADs?
Both of us are on H1B only.
Okay, then maybe you need to check with your immigration attorney. But I think if wife was an H4 EAD, then if she's not, I think that's what we were talking with Elder also. Elder, like if both are on W2, it becomes harder, right? Like if one of them are on the non W2, then it's easier to file for the short-term rentals.
Well, if both of you guys are in W-2, really the only way that you could benefit from depreciation is via the short-term rental loophole. However, if one of the spouses is not a full-time W-2 worker, let's say they don't work or they only work part-time, they can qualify for real estate professional status or REPS, real
Yes.
estate professional status. That is purely an IRS test. That is somebody that does real estate 750 hours per year, and it's the majority of their time. So as a W-2 worker, you can't qualify. but as long as you do real estate the majority of your time and it's 750 hours at least, then you can bonus depreciate any property that you owe. Short term, midterm, residential, commercial, it doesn't matter.
Yeah. So when it's basically if both are on W-2, it's difficult to qualify, but one of them are in the H-4E part-time they're working, right? Then they qualify for a real estate professional, what as the elder is saying. So based on that, you can for short-term rentals, you can qualify. Any questions, Venu? Follow-up questions?
So I have a follow-up question.
Uh-huh. Go ahead.
What if the properties are like long rent, like 1 year rentals, not the short-term rent?
Definitely, yeah. So if it's a long-term rental and you guys are both W-2 workers, that will be treated as passive. The IRS views three different incomes. There's earned income, which is W-2 or business. There's investment income, which is stocks, bonds, ETFs, crypto, and then there is passive income. Passive income is largely real estate investing. So with long-term rentals, you're either getting passive income or passive losses. But if you're generating passive losses now, they will be saved until you have enough passive income and you'll offset these losses in the future. And then if one of you ever qualifies for reps, real estate professional, like let's say you go part-time, or you quit work altogether, you can qualify yourself as a real estate professional. And then all of the future losses on real estate will become active and they will offset your spouse's income.
Any follow-up questions, Venu, on this?
Okay. For how many years we can roll over these losses?
The losses carry on forever until you have enough income to offset.
Got it.
Okay.
Yeah, that's all I have. Thank you. Thanks for the.
Thank you, Venu, and best of luck. And if you have any questions on the real estate also, go give us a call back and best of luck. Listeners, you're listening to Real Estate Show. Myself, Realtor Nagaraj Hanaya, and I'm talking to Elder from CPA Dude. We are talking about anything on the real estate and the tax things. Okay, if you have any questions, you can give us a call 877-265-5992 because your future needs a better foundation. That's what we're trying to do it for you. Educate, educate, educate so that you can do a better investment for yourself. Any questions, do give us a call. Our studio line numbers are 877-265-5992. So I think the most complicated part is always the depreciations and short-term rentals, which a lot of folks misunderstand, but thanks for that helping out. And one more thing, Elder, like how about depreciating a foreign property? Like if I have some properties in Canada, India, how do I do that?
Definitely, yeah. So you can depreciate foreign property if it's used for investment or business purposes. So for example, if you have a home or business property in Canada or India, you will take standard depreciation. So if it's residential, 27.5 years. If it's commercial, 39.5 years. Unfortunately, you cannot bonus depreciate foreign property.
Okay. The listeners, like what Elder is trying to say is like you can't faster depreciate, like you can't do it, get a cost segregation and do it like it's a basically we say is like we need to depreciate slowly. It's the same 27 years, right, Elder?
Exactly. Yep. 27.5 years for residential or 39.5 for commercial. Something that is unique, though, is that the primary home exemption does apply to foreign property. So, for example, let's say you had a home, you lived in Canada for 3 years,
Uh-huh.
you moved to America, you sell your home in Canada. Even though the home is in Canada, you still have to pay tax on it in the US. However, since you lived in that home for 2 out of the last 5 years, you still qualify for the primary home exemption, which is $250,000 for single people or $500,000 for married people.
Okay, the same thing, the 5 years rule applies. Is that the same thing?
Exactly.
5 years applies.
Exactly. So if you've lived there for out of the last 5 years, you can sell your foreign property if it was your primary home and get that exemption for US tax purposes.
Got it. Listeners, if you have any questions on the real estate, any questions on the taxes, I'm talking to Elder from CPA Dude, myself, Realtor Nagaraj Annaya. This is the time all your questions gets answered. Give us a call. Our studio line numbers are 877-265-5992. So let's talk about the kids, right? Like a lot of kids, like we start like basically paying a kids, like this is what we had talked about, how you can basically offset paying to your kids. But when the kids start paying taxes, what is it, based on the income what they earn, or like it's based on the age? How about that, Elder?
Definitely, yeah. So I mean, a lot of people with businesses or real estate investments will pay their children.
Mhm.
It's great to get your children involved in your business, and it also creates a deduction for you. As
Ah,
long as you pay your child, as long if they're below 18, as long as you pay them below the standard deduction, they
uh-huh.
will not have any income tax due, and they will not need a tax filing because there is no taxable income.
Oh.
Uh, so if they're 18 and under, as long as they make below 14,600 for 2024,
Mhm.
no filing needed. However, once they turn 18,
Uh-huh.
as soon as they have any income, they need to file.
Okay, so it can be a cash also, it can be paid through a basically bank account also, right?
So paying kids, it really depends on your structure.
Mm-hmm.
That's something that we do at the CPA, dude. We build a plan for you for how to effectively pay your children so that your children actually do get paid tax free and that we don't trigger any payroll taxes. Because children below the age of 18, if they work for their parents, should not be paying payroll taxes. But
Mm-hmm.
that does take some structuring.
Listeners, see, most of them like planning for like college and other things. But have you ever thought about paying your kids and making them basically enrich, or thinking about how this all this works? See, this is where it comes in, right? Like if you have any questions, you can give us a call. We have a few more minutes, like our studio line numbers are 877-265-5992. So basically you can build your kids' wealth also along with you, not only on the insurance part, but even paying your kids. There are two better ways to pay for your kids. Up to 14. What was the maximum income you said we can pay for them?
For 2024 is 14,600. The
Hmm.
smart thing to do would be to take $7,000 and put it into a Roth IRA.
Uh-huh.
That's the max. And then this Roth IRA will grow tax-free forever. And it can
Uh-huh.
also be used for educational purposes down the line.
Uh-huh.
So paying your kids, having them open up a Roth IRA is a much, much smarter plan than a 529 plan.
Okay, yeah, that's really true, right? Like, and one more thing, this applies even for H1 folks, H1B folks. That is not anything related to visa here.
Correct, yep.
Yeah, you see, yeah, listeners, myself, Realtor Nagaraj Annaya, and I'm talking to Elder from CPA Dude, and we are talking all about the tax saving strategies and the real estate. So, one more important thing, Elder, like what factors should investors consider when deciding whether to hold or sell a property at the year end? So, what is your suggestions on that?
That is a great question. I think it truly depends on what are your goals as an investor. So, for example, somebody that is young is probably looking at appreciation, right? So, if my property is appreciating well and the value of my property increases year over year, I'm
Mhm.
happy with that because I don't really care about cash flow, right? As a young person, I probably have a W-2 job, probably have a business, so I'm getting income somewhere else.
Mhm.
However, as I get older, I'm going to care more about cash flow, right? When I'm nearing retirement, I'm going to care more about, okay, well, how much cash am I getting every month from the business?
Yeah.
So I think the 1% rule is very, very important. If your property is not nearing the 1% rule based on value, meaning that if your monthly rent is not almost 1% of the fair market value of your property, odds are you should put that money elsewhere to get a greater cash flow return.
Got it. Okay. Listeners, you're listening to Real Estate Show. Myself, Realtor Nagaraj Annaya, and I'm talking to CPA Dude. If you have any questions, anything on the tax purposes or anything on the real estate, you can give us a call. Our studio line numbers are 877-265-5992. Let me repeat, 877-265-5992. So basically, it's one more thing is like it's not only a cash flow. I think two things you brought in, like young and older, right? Like for older wise also, as you said, the cash flow also matters. And again, the one more thing is like, what about the depreciation factor also? Like once we have one more call, let's take it up. Hi, welcome to the Real Estate Show. Myself, Realtor Nagaraj Annaiah.
Hi, my name is Anand.
Yeah, Anand, please go ahead with your question.
Yeah, I would like to ask one question.
Uh-huh. Go ahead, please.
Yeah, see, my question.
Yep. Go ahead, Anand. We're listening to you.
Yeah,
I think we
Yeah.
lost. Go ahead, Anand, please.
Nagaraj, you are able to hear me?
I can hear you.
Yeah.
Please go ahead. Yeah.
I hear my own echo. That's like.
Yeah, go ahead, Pav. Yeah, we have only few minutes left. Please go ahead. Your
Yeah.
question.
So I have a property in Bangalore,
Uh-huh.
which more than 8 years back.
Okay.
I'm trying to sell the property, finalize the sale. It's sold in January.
Okay.
And my plan, once I said that using that money to clear a home loan in India.
Okay.
What is my.
I think, okay, your voice is not so clear, Anand, but I heard few things. But let's talk to Elder. Elder, if any property is sold in India, Bangalore, he will be eligible to be paying taxes, right? Since he's like stayed 8 years back.
So he's selling a property in India?
Yeah, he's going to sell a property in India next month.
Correct. So if you sell a property in India, you will have to pay US tax. There is some benefit. For example, there is a treaty between US and India. So you will have a partial tax credit. It will not be the full credit, but you will get a slight break on your US on your US tax return.
Does it answer your question, Anand?
Okay.
Anything else you have?
Yeah. So I should declare in the current financial year or in the next year?
You need to report it once the property is sold. So as soon as you sign the document saying the property is sold, I've received the money, that's the year where you report it.
Okay. Thank you.
Thank you, Anand, and best of luck. And do set up a call with CPA Dude. You can go to the CPA Dude and set up a call with them or set up a meeting with them. It's a free consultation. Any of your questions get answered from the finance, real taxes purpose. Listeners, myself, thank you, Anand. And listeners, if you have any questions, I think we are not be able to taking any questions. We can take one more last call, Elder. Yeah, please go ahead with your question, please.
Yes, I had a question.
Yeah, can you do it faster? We have only.
The question was
Go ahead, please.
If the child is going to college and they are dependent on they're over 18. So what do you recommend separately and same as a dependent or?
I think your audio is not so clear, but do give us a call back. I think we are not able to understand your question properly, but you can give us a call back or you can set up an appointment with the CPA Dude. Do give us a call back, but we have just few seconds left. Maybe we can't take any more calls. Yeah. So, Elder, like if somebody wants to reach out to you, what's the best way to reach out to you, Elder?
Definitely. They can go to join.thecpadude.com. That's join.thecpadude.com. You have a video there that'll explain to you how we work, how we're different from other CPAs. It'll ask you some basic questions, and then it'll take you to a link to schedule your first call with us.
Okay. Thank you, sir. Thank you, Elder. And listeners, if you have any questions on the real estate, the best way to go to is go to nagrajhome.com and click on a WhatsApp icon, and it's easy to reach out to me. Anything on the Bay Area real estate, it's a one-stop solution from me. You can reach out to me, anything on the Bay Area. If you want to plan to buy or sell in the future, also do reach out to me. And thank you, Elder, and have a wonderful evening.
Thank you, Nagaraj. Thank you for having me.
Yeah, thank you for each and every listeners for calling in today. Thank you so much and have a nice evening.